Is it worth investing in gold? I'll be honest from the beginning. I am not a fan of gold. And for most of my life, I have avoided it completely. Not because it's useless, but because, as an investment, gold has some serious weaknesses that are often ignored. First of all, gold does not generate yield. If you buy gold instead of bonds, you give up interest income. If you buy gold instead of stocks, you give up dividends, earnings growth, and long-term compounding. Gold just sits there, and historically that matters. Gold can lose value for very long periods of time. From 1980 to 1999, gold lost roughly 80% of its value in real terms. It did not reach a new inflation-adjusted high again until April 2025. That's more than 4 decades of underperformance. Over that same period, the stock market rose by almost 19,000%, including dividends. So by traditional investment standards, gold failed badly. And yet, in 2025, gold shocked almost everyone. Its price rose by 65% in a single year. Moves like that don't happen without a reason. When something performs this well, this suddenly, it forces us to look deeper. Because this wasn't speculation. This was something else. To understand what happened, we need to rethink what gold actually is. When something is treated as an asset, people speculate on it. They trade it. They try to time it. But when something becomes money, behavior changes. People stop speculating. They start holding it to protect wealth. For centuries, gold played exactly that role. It was money. Then, after World War II, the US dollar replaced gold as the foundation of the global monetary system. Since then, the dollar has been the base layer of global trade, reserves, and settlement. Gold slowly became just another asset. That is now changing. For most of the 2010s, central banks were steady but not aggressive buyers of gold. Then, starting in 2022, something changed. Gold purchases more than doubled. And they have remained at elevated levels ever since. This was the moment when gold stopped behaving like a speculative asset and started behaving like money again. So what is pushing gold higher? Part of the answer is politics and monetary risk. In January 2025, Federal Reserve Chairman Jerome Powell revealed that the Department of Justice had issued grand jury subpoenas related to his testimony about the renovation of the Federal Reserve's headquarters. At the same time, it was no secret that President Trump wanted Powell out as Fed chair. Even if no charges are ever filed, the clock is already ticking. Powell's term ends in May 2026. That opens the door to a new Fed chair who would likely be far more willing to cut interest rates aggressively. When central banks cut rates, gold tends to rise. Why? Because lower interest rates reduce the opportunity cost of holding gold. And aggressive rate cuts increase the risk of inflation. In those environments, gold benefits. There is also a psychological factor that most people ignore. Look at the average age of the men and women who run the world's major central banks. Most of them are in their early 60s. They were trained in a world where every major crisis ended the same way. Currency shocks, market crashes, geopolitical conflicts. And each time, gold prices surged. So when today's financial system begins to wobble, they are not looking for something new. They are reaching for what they already know. Gold. That is one of the main reasons gold rose by 65% in 2025. We are also witnessing something larger. The slow de-dollarization of the global system. Countries are gradually reducing their reliance on the US dollar as the primary reserve and settlement currency. Instead, they are shifting reserves into alternatives. And gold remains the most politically neutral option available. So, is gold actually a good investment? The honest answer is that it depends entirely on why you own it. If your objective is long-term growth, productivity, and compounding, history is very clear. Assets that generate cash flow have consistently outperformed gold over time. But if your objective is protection, the framework changes. What we are witnessing today is not just another market cycle. It is a structural shift in the global monetary system. Central banks are no longer behaving like short-term traders. They are behaving like long-term custodians of national wealth. And when institutions with virtually unlimited time horizons begin accumulating gold, they are not chasing returns. They are hedging against uncertainty. Gold is not innovative. It does not compound. And it does not respond to narratives. It serves one purpose only: to preserve value when confidence in the system begins to weaken. That does not make gold a great investment, but it does make it a very specific tool. And in a world where trust itself is being repriced, tools like that start to matter again.